The following is a presentation of TFNN. Now, TFNN opens the door to the future. Larry Pesavento, systems analyst, is your tour guide into the market futures. Want to see into the future? Well, climb aboard Larry's time machine and come with us. Larry takes your phone calls now, toll free at 1-877-927-6648. This is the Futures Hour. Here's your host, Larry Pesavento.
Okay, folks, good afternoon and a Happy New Year to everyone. Starting the show today in the TFN Tiger TV, I put in the IWM, which is the small cap index, because it has the huge gap up. Well, all the indices do, but this one has a tremendous gap up, and we are, we just took out the highs that we made, way back a long time, many months ago. And so that, with that huge gap that's there, all you have to do is look at that chart and you'll see that almost all these gaps are filled. The question is when. The $64 question is, what caused this big move that came off of the full moon that happened on the 28th. Now, it could be that cycle moon, because it was a blue moon, which is two full moons in the same month, but frankly, I don't think it's that. I think it's something else. One of the things that could have caused all of this buying is the fact that there was so much money sitting on the sidelines because volatility had been, so low, and then we had the big spike up at the Gartley pattern up at 23 in the VIX index, and in just a matter of 3 days, we're down to 1440. When you can get a market can drop a third in price in a matter of 3 days, that's a tremendous move. And also we have a huge gap, in the VIX index now. So all of these are outlier events. They're very difficult to interpret because you don't see them very often. I can tell you the history of gaps that I've studied, and I've looked at all of the main indices and all the main stocks that have been published since 1876, and nearly all gaps are filled. In fact, there's only one gap on the Dow Jones Industrial Average, and that is the gap after the Desert Storm, January of 91 war, the war that lasted just a few hours. There's a gap there because the next day, the Dow Jones, every stock in the Dow Jones gapped up sharply. It was, I believe, the single biggest up day the Dow has ever had on a percentage basis, as I recall. That was a huge day. Crude oil was down $11 a barrel that day. Gold was down over $40 a barrel, an ounce, and it was a really big change in the thinking of everyone, and that started the huge bull market that took us up to 14,000 in the Dow. The Dow was trading at around 2,900 at that time, as I recall from memory. But these gaps are usually filled, but we do have this outlier event. There's many reasons for it. I posted two, the IWM, the VIX index is another one, the S&P could be another one, the Dow Jones is another one. There's quite a few of them that are there. Today, the NASDAQ has finally went a little bit above the 61% retracement of the high, up around this 2745 area. The S&P has already gone above, the 786. Looks like it's going to challenge the high. And if this is a new leg of a huge bull market, and you have to think that it is, because the low that we made on the solar eclipse and new moon of the 13th of November was a 61% retracement off of the previous June low, and then the full moon low that we had on December the 28th was 61% off of the one on November the 13th. So those are holding up, relatively well. The one thing I do know for sure is that if we go below that low of December 28th, which is 1385 in the S&P, we are going to be in a really bad market. Remember, I mentioned this before on yesterday's show, the words of Thomas Jefferson, about government, and all you have to do is take the word government out and put in market. But any government can give you anything has the ability to take it away. So any market that can give you anything has the ability to take it away. So be careful. One of my very favorite books, and I mention this all the time, is My Own Story by Bernard Baruch. And he always mentions in there that the greatest scam in Wall Street is to inflate things, to a very high price, and people will buy it all the way down. And we've seen this many times. We've seen it in Enron, WorldCom. There's so many Jupiter Networks. I mean, there's CMGI. I mean, all these stocks that were, octogenarians, trading in the hundreds of dollars back in 2000. Many of those, went bankrupt. So just because markets go straight up don't mean they can't turn around. I'm just saying that this is an outlier event. I don't know how it's going to play out, but it is unusual. The good part about this is that this volatility is a signal that we're going to have some huge swings in these markets, and that's what I'm really excited about for 2013. Not the fact that it exploded the first couple of days. We've seen this happen before, not like this, but we've seen this market move quickly and then reverse, both on the upside and the downside. So you have to be a little bit flexible. I have never had any luck in buying strength and breakouts, like we're seeing now. If I go back and look at these charts, it's just very difficult, to see where you can, you have to determine, how much you're going to risk if you're going to buy the breakout. If you're going to buy the breakout today, you have to put your stop under the lows that we made, 2 days ago. Now with the IWM, that's not very much because the market was closed most of the time. However, at 6 o'clock in the morning New York time, the futures open, and so there was a big difference, in the prices that we had then and than where we are now. So we'll have to wait and see. Actually, the futures are up just very marginally from that opening on the day after the holiday on January the 2nd. So those are the things that I see. Now I want to get to the commodity part of this because we have some really interesting things happening in the commodity markets right now. I'm going to start out with the DBA because that's the ETF for the commodities, and I wanted to. I put it right here in front. Here it is. I have a tendency to lose these things, and I wanted to be able to look at it because we're very, very close to this price level that we've been watching, for quite a while. The thing is we're having some breakdowns in a few of the commodities that we've been watching. One is let's finish the DBA first. I'm sorry. I'll try to keep my train of thought. If you get into Tiger TV, you'll see that we are within about 15 cents of making the 61% retracement, the ABCD pattern coming down, which is also a 3-drive pattern coming down in the DBA, which is suggesting that we're making a pretty significant bottom here in some of these commodities. That's what this chart is telling you on an ETF basis. But what we need to do is to look at the major commodities behind this, just to see if that verification is actually valid. And so the main thing that I'd like to do is we will start out by looking at the premier crop that we have in the United States, which is our corn crop, and I will put it up, and we're going to do it on a weekly basis because we'll get a better idea of what we're looking at here, because we've had this pattern that is formed for quite a while now, and we've had a couple of really good rallies in the corn market, and what's happening is right now is that we're breaking down. We've had 2 rallies of well over $1,500 a contract in the corn, and now we are, we're breaking below the 61% retracement that came in at $6.90 a bushel. We're now trading at $6.88. Well, that's just 2 cents. But the problem is that we've had, several $1,000 rallies from that level. And that's telling us that, we're having, a breakdown, in this market. Now, it's going to have to do some reversing here if it's going to hold up. But if it fails here, it's going to pull down all the way down another, 28 cents, which is well over $1,400 in corn, down to to the next level, which will be the 61% level. And so this is starting to fail. we mentioned this in wheat on the show last week. The fact that wheat was not acting nearly as well as it should be if the pattern that we were looking at in wheat was going to be a really big one. And so the next thing that we will take a look at is the weekly chart in wheat, because we are at a point now where we are almost heading towards the 61% retracement, which is another $2,000 to the downside in the wheat market. We've broken below the 50% level. We've broken below the ABCD level that we looked at. Now, we had nice rallies off of those ABCD moves, but they didn't last very long. They would only last for $1,000 or $1,500, and then they would, literally reverse and go down again. So this is telling us that we're not quite there yet, and maybe that's what that DBA is telling us, the ETF for the commodities, that we still have just a little bit farther to go before we hold up in these commodities and see if it's going to do that. Now, after we have the break, I'll certainly go into gold and silver, because we're at a very critical level in the gold level as we speak, and as we talked about on the show yesterday, at 1690 level. So we've held up relatively well against that point, which is good. But we've covered the corn, and we've already said that it's starting to show signs of weakness. The wheat is also showing sign of weakness. And the next one that we will cover will be the price of soybeans, because those are the three main growing crops that we have in the U.S. And I will get the soybean one here in just a second, if I can find it. I know I have it. Here we go. And it'll be just it's really hard to do two things at once when you're doing this by one hand, and I have a rough time because I have a hard time walking and chewing gum at the same time. Okay, then I'm going to post the daily chart in soybeans going back about 2 years, and you'll be able to see the top that was made at the ABCD pattern that completed the butterfly pattern up at that $18 a bushel level. That was right in the midst of the drought. We made a major double top up in that area. And now what's happening now is we're retesting the 61% retracement. We're within about 10 cents of that. That's $13.62 a bushel. We're trading at $13.76 a bushel now. But the ABCD measures all the way down another dollar a bushel, which is well over $6,000 contract. So I think we have to wait and see how this holds up. Now, as a short-term trader, and as a risk-averse trader, like I try to, teach my folks, is that, when we get down to make new lows down here at this 1362, I will be, okay.
In just December of last year, the price of gold was down over 10%. In today's highly volatile gold market, you need someone in your corner that understands the complex relationships that exist within the price of gold, as well as within a variety of gold equities. Whether it's the South African gold miners and knowing how the Rand-dollar relationship will affect their bottom line, or understanding how John Paulson's $5 billion trade in the GLD can move the market, Tom O'Brien gives you the direction you need to become a better trader each week in his newsletter, The Gold Report. With over 20 individual equities covered and almost another 20 on the potential watch list each week, in addition to covering the XAU, HUI, GLD, and dollar, The Gold Report is a great source for any trader that is looking to be diversified in today's volatile gold market. For your 30-day free trial to Tom O'Brien's Gold Report, log on to TFNN.com today. Don't miss out on this great offer. Act now. You've always taken the long view when it comes to investing, but what if there's an opportunity right under your nose? What if you could be more responsive to market trends to seek to boost your portfolio performance right now while seeking to reduce your overall risk? At Direction Funds, we connect investors with alternative strategies that seek to maximize their returns. Smart investors deserve smart alternatives. Find yours at directionfunds.com. An investor should consider the investment objectives, risk charges, and expenses of Direction Funds carefully before investing. The prospectus and summary prospectus contain this and other information about Direction Funds. To obtain a prospectus or summary prospectus, please contact the Direction Funds at 800-851-0511. The prospectus or summary prospectus should be read carefully before investing. Investing in index funds may be more volatile than investing in broadly diversified funds. Distributed by Rafferty Capital Markets, LLC.
Millionaires are made every day. The fact is, living your dreams is possible. Someone, somewhere is going to get rich. My recommendation is, let that be you. Each day, someone is making the decision to better themselves and creating a plan to fulfill their financial dreams. Let that be you. The key to turning dreams into reality is to take massive action. Let that be you. I'm Steve Rhodes, co-host of the Money Master Show with Tom O'Brien, seen daily at TFNN, and I can help you with your journey to great wealth. I'll show you how to create the ultimate financial edge, a set of tools, insights, and strategies that are part of my daily newsletter service, Mastering Probability. You'll have direct access to me by phone, email, and my private library of trading and investing secrets for 30 days with an unconditional money-back guarantee. I'll take your trading to the next level. Click on my name, Steve Rhodes, on the homepage at TFNN.com and turn your dreams into reality. Mastering Probability, folks. Let that be you.
What type of investor are you? Conservative, moderate, or aggressive? No matter your investor personality, your overall portfolio should reflect your financial goals, time horizon, and your risk tolerance. Help ensure your portfolio is appropriately invested with an asset allocation plan from Morgan Stanley Wealth Management. Simply picking the right stocks is not enough. Research has shown that choosing the right proportions of stocks, bonds, and cash is essential to the success of your long-term investments. Morgan Stanley believes a carefully selected portfolio can lower volatility and increase investment return potential. Find out about what an asset allocation and a Morgan Stanley Wealth Management financial advisor can do for you. Call Angela O'Brien, First Vice President and Financial Planner of the Clearwater, Florida branch at 727-441-6108 today to discuss your personal financial needs. Asset allocation does not assure a profit or protect against loss in declining financial markets. Investments and services are offered through Morgan Stanley Wealth Management, LLC. Member SIPC.
This segment is brought to you by Great Panther Silver. For more information, just click the Great Panther Silver banner on the front page of TFNN.com. Now, back to the Futures Hour.
Okay, we're back, folks, and one of our regulars in the Tiger family, Danny from Atlanta, sent us a little message telling us about the depth of the Mississippi River, and the barges are having a lot of trouble getting through. I'm going to have Rich Anderson on next week from Anderson Capital Management, and we'll talk about that. You know, Rich is in the cash grain business, and he'll be able to tell us more about that. But that is a big problem, because if the grain barges are not able to get through, they have to be people that want to buy this stuff will go to other sources. They'll buy their corn from either South America or India or other places like that, because mainly South America, that's the largest competitor. But that's what we're looking at now. One of the things that I want to talk about is that soybean market that we're looking at, with soybeans trading at $13.77 a bushel. I'm going to put into Tiger TV what I think is a very interesting chart. It is the long-term weekly chart of soybeans going back a couple of years. It shows the big butterfly top that we made up around $18 a bushel that we talked about a little earlier. And now what's happened, we've come down and we've touched the 61% retracement at that $13.70 level, and we rallied well over $6,000 a contract over a 6-week period. And in the last 4 weeks, we have given all of this back, and now we are down and we are testing that same low that we made back in November when we had the solar eclipse and the new moon. That all occurred at the same time. And so we have to really watch this price of the 13.60 level per bushel in soybeans, because if it just goes down there and touches it and doesn't turn, that's a really great buying opportunity. I would really be looking to be a buyer of that if it can hold. And you only have to wait a couple hours to see if it's going to hold or not. If you want to take the reverse position of that, all you have to do is look at that same chart and go back to see how the high was made, during the time of July and September. It made a high in July. The market came down for 4.5 weeks. It rallied 5 weeks. It made a new high by 4 cents. And then it, gave up well over $20,000 a bushel. So this is what we have to be watching in soybeans at the present time, because we're right at that 61% retracement at that 13.60 level, and we will see. Now, the question that someone posed me, what would you have to risk on this trade? Well, there are two ways you could handle this. One is you could probably, buy a $14.25 call, $14.25 per bushel call, which probably wouldn't be more than $500 to $1,000. Or you could just put a 15-cent stop on the beans, risking $750. So you would become a farmer for $750 as opposed to owning the land and the equipment and the time and the grain and the fertilizer and all this stuff. So we'll see if that does it. The corn trade that we looked at actually made pretty good money, because it made $1,000 twice, because it had those $1,000 rallies, and so far the trade has still not been stopped out, but it's come within 2 cents of being stopped out. But frankly, it's not acting very nicely, but it's still in there, and we'll have to wait and see how that unfolds. After we come up to the break at the half hour, I'm going to cover the bond market, and I'm also going to cover the natural gas market, because we've had some huge moves in that natural gas market coming off that 786 level, and we'll take a look at that. As a matter of fact, I think we have enough time here to start with natural gas, and I will put it up, and we'll take a look at it from here. I know I put it in here somewhere. Yep, I've got this categorized, and we'll take a look at this. This is a real interesting one, because we're retesting the 61% retracement. We hit that yesterday down at that 1610 per cubic feet level, and that's a really interesting chart, because the cycles are holding up really nicely, and all we need to do now is to see natural gas hold above the 1304 level, and you've got a pretty good chance of a nice rally in that. And after the break, we'll also cover crude oil, because we're coming into this crude oil ABCD pattern that we've been watching for quite some time, right near 94.25 a barrel, and we got to almost $94 a barrel yesterday. So we'll have to keep an eye on that one too, because that is completing the pattern at the same time. But we're going to take a little break now, 877-927-6648, and if you have any questions, call in, and I'll be happy to answer them if I can.
You've heard Tom O'Brien on the air, and you've seen him on Tiger TV, as well as being featured as a regular CNBC guest and contributor, and now you can have access to his expert trading advice each morning through his daily trading newsletter, Market Insights. Tom O'Brien's daily newsletter, Market Insights, gives traders, investors, and money managers a thorough strategy for trading stocks, options, and indices every market day. Market Insights comes out each market day before 9:30 a.m. and provides traders with Tom's daily commentary, opinion, and specific trade recommendations on the markets. Using advanced Fibonacci methods, volume indicators, Gartley patterns, candlestick charting, gaps, and market timing, Market Insights will give you specific trade recommendations, including entry, stop, and exit prices. The summer is over and traders are back. Get your 2-week free trial to Market Insights today by visiting the front page of TFNN.com. In quiet markets, investors search for new trading opportunities. We'd like to introduce you to a new product that provides opportunities even in flat markets. Nadex, the North American Derivatives Exchange, is a new and innovative Chicago-based exchange registered with the Commodity Futures Trading Commission, and unlike most other exchanges, Nadex allows you to trade directly through them with direct market access when using their trading platform. Nadex never charges a fee to use their platform, which even includes real-time charts and full customization capability. Nadex's unique short-term binary options allow traders and investors to capitalize on strategies even when the underlying markets are quiet. Nadex's innovation has allowed them to come up with a line of unique trading products that are unavailable anywhere else. See how it works at nadex.com. That's NADEX.com, or click on the Nadex banner on the front page of TFNN.com. Futures and options trading involves risk and may not be appropriate for all investors.
Recently, Basil Chapman has had some outstanding trades in his newsletter, The Opening Call. Each morning by 9 a.m., Basil uploads his newsletter to the TFNN servers so that his subscribers can access his expert trading advice. Basil gives his take on the direction of key indices and updates any active trades that his subscribers are currently in. Just recently, Basil's subscribers closed out a short position in Chipotle Mexican Grill, CMG, for more than an $86 profit per share, over a 20% gain in just one position. If you'd like to try out Basil Chapman's newsletter, The Opening Call, then visit the front page of TFNN.com and click Trading Newsletters. There you'll find Basil's newsletter, The Opening Call, where you can request a free sample copy. Also, don't miss Basil's program, The Tiger Technicians Hour, Monday through Friday, 11 a.m. Eastern, on TFNN.
In just December of last year, the price of gold was down over 10%. In today's highly volatile gold market, you need someone in your corner that understands the complex relationships that exist within the price of gold, as well as within a variety of gold equities. Whether it's the South African gold miners and knowing how the Rand-dollar relationship will affect their bottom line, or understanding how John Paulson's $5 billion trade in the GLD can move the market, Tom O'Brien gives you the direction you need to become a better trader each week in his newsletter, The Gold Report. With over 20 individual equities covered and almost another 20 on the potential watch list each week, in addition to covering the XAU, HUI, GLD, and dollar, The Gold Report is a great source for any trader that is looking to be diversified in today's volatile gold market. For your 30-day free trial to Tom O'Brien's Gold Report, log on to TFNN.com today. Don't miss out on this great offer. Act now.
This segment is brought to you by Crocodile Gold. For more information, just click the Crocodile Gold banner on the front page of TFNN.com. Now, back to the Futures Hour.
Okay, folks, we're back, and we have a caller from Jackson, Mississippi. Are you there, Brian?
I'm here. Yes, sir. How you doing?
Very good. You wouldn't know a Rick Redmont down there, would you?
I think you asked me that a couple of weeks ago. No, is he the guy that was?
Yeah, he's a very famous cotton trader. He's a third-generation person of Jackson. I think his great-grandfather started the country or the city or something. But if you don't know him, it's no big deal. He's older than I am by about 2 years. So what can I do for you, my friend?
Listen, I'm mainly trade options, but my question was, I've been listening to y'all's show for a few months now, and what's the biggest difference between trading futures contracts and options contracts, and what would be an advantage one for the other over the other?
Well, if you do a futures contract, it's a contract to deliver into the futures. With an option, you're buying something that has a decaying value. I don't know if you've ever been to Chicago, but if you ever get a chance and go into the Chicago Board Options Exchange, the floor traders that are there wear these badges, like political badges, only the badge says sell an option, buy a Mercedes. So the best thing you can do is to learn how to sell options, because most options, I believe the figure is 85% of all options that are purchased expire worthless. In other words, the puts that you buy expire worthless, and the calls that you buy expire worthless. However, if you sell a call, you're taking in a premium, and that gives you a huge advantage. Not only that, the fact that you have an 85% chance of winning on that, because that's the reverse of the people that that buy options. So if you learn to be an option seller, you're taking in a premium. The problem arises, Brian, is when you're wrong. Because if you sell an option, you have a situation where you have an unlimited liability when you sell an option. If you buy an option, your liability is limited to the price of the call or the put that you buy. So that's the main difference between futures and options, is the fact that it has a limited liability when you buy a call or a put, but it also has unlimited liability if you sell a call or a put. With a futures contract, you have that same liability, but it is really it doesn't have the same time limit because you can roll it over into another contract and you can do the same thing in options, but it's mainly the fact that the options have a expiration and it's a decaying value. That's the main thing between the two of them. And the leverage on the options is huge. You do have a huge amount of leverage.
Well, there's no time decay on a futures contract.
That's correct. I believe that TFNN has some good educational information on their site that is helpful. You can also go to the CBOE options place. Their website, and I'm sure they'll have some good information there. But before you do any of these, you really should research it because, options have the, the alphas and the thetas and the betas, all these little Latin phrases that they have. The Greeks, and that's what makes it a little different because the time decay on these is very important. You need to know something about options before you really do them. Futures are quite easy because you just have a couple of options expiration months, and they're much easier to use. But options are very, very sophisticated. But if you learn to do them, they are a very good money-making way of doing them. But I would recommend learning to be an option seller. In other words, learn how to sell puts and learn how to, sell calls in order to take the premium in because
right.
That's where your real money is because these premiums are, 85% of them expire worthless, and that's the ideal situation. It's the 15% that don't expire worthless that count. I have a little bit of information because I have a lot of friends that do options, and they have a iron fast rule, and that is if an option that they're in doubles in price, they immediately get out. In other words, if they sold an Apple call at 10 and that call goes to 20, they just immediately get out of it. Whenever the option price doubles, they just take the heat and get out, and that's it. That's their risk parameter that they use. So I don't know if that would work for you, but you might want to check it out a little bit.
All right, and I have a quick question to ask you. I know this is a commodity show, but if you could take a real quick look at the SPY.
Sure.
Well, it looked like at one point it was trying to form a head and shoulders starting back in like March or April.
Yes.
Has that broken now? Did it gapped up above the?
This gap that we've had has certainly been an outlier event, and it's gone above the 786 today. The head and shoulders pattern. If you're talking about the one that goes way back from April of last year, that really doesn't have a great deal of symmetry, in my opinion.
Right.
I really like to see head and shoulders patterns that have a lot of symmetry, and that's not really what we have going on here. What I think has happened here, and this is just my opinion, my 2 cents worth, is that whenever you see something where you have 2 days where you have this tremendous move, 500 points in the Dow and 60, 70 points in the S&P, and the IWM, the small caps going crazy. That's just some big emotional event. I believe it's caused by some type of a cycle, but unless it was that full moon cycle of the 28th, I don't know what it is. All I'm saying here to folks is to set on your hands here because we have an outlier event, and we've left a huge gap, and almost all of these gaps are filled. So my suggestion, Brian, is just to wait. That'll give you a chance to trade. The good part is the volatility that we're getting is a good sign because that means we're going to have a really good volatile market for 2013. Much quieter than we had or much more active than what we had in 2012.
Well, thank you so much, Larry, for your time and everything.
It's my pleasure, and thank you for calling in, Brian, and Happy New Year to you. I appreciate it.
Thank you.
Okay, now we're going to take a look at that Treasury bond chart that we talked because I think this is the one that many people have had a lot of interest in, including myself. I was originally looking for the Treasury bonds to form a perfectly symmetrical head and shoulders pattern coming in on January the 4th, which would have been Friday, around the 149 level, and we're 4 points below that now. The $64 question is, did it come in 3 days early? And that answer is probably yes, because we took out the lows of December 17th, and right now we're very close to the 786 level in Treasury bonds at that 144.28 level. What I will be looking for is the first rally in Treasury bonds, against this head and shoulders pattern, if in fact it has completed early, and I really believe that it has, because we did break out of that December 17th level, and so I think this is the real scary thing in the markets for 2013 are higher interest rates. That's what I really believe. I thought that last year. I was wrong, but I still believe that long-term 30-year pattern in Treasury bonds, that big butterfly pattern that we've had filled at 154, is now complete. This head and shoulders pattern is further verification that this is happening, and so we'd be looking for a place to get short the bonds. I don't sell into weakness here, because you have no way to control your risk. These bonds could rally 2 or 3 points real easily, if the market decides to back off for a little bit. So I'm waiting to get a better entry point. I'm not going to do a breakout trade, because I have very little success with those, but I do the patterns, and we'll be able to look like that, and we'll be able to take a look at it. So anyway, this is what I'm looking at in the Treasury bond market. The notes have already have weakened up also, which we pretty much expected. Once we went below the 146 level, that said pretty much that we were going to go down to the 786 level at that 144.28 level in the Treasury bonds. But these markets are going to trade. I mean, we had a lot of emotionalism the first couple of days of the year, and we're a little more civil today. The market's up, but not up by much. So we're still in a zone where we can have a nice little pullback here. And if the market is really bullish, it'll give you a really good chance to to take a look at it, and we'll be able to see if we can enter it at that time. We had a question about a stock that I don't know, so I'm not going to try to answer it unless the person from Boston calls in, because I really don't know what the stock is, and there's so many stocks that are, that are out there now. Actually, when I first started trading stocks, to get off on it was back in January of 1965. And the volume on the New York Stock Exchange that day in January set an all-time record of 5 million shares, if you can believe that. There were only, I believe, 1,600 issues at that time traded at the NYSE, but the record volume that day was 5 million shares. And remember, we traded in quarters and halves. In other words, it was a stock like Apple would trade at 500.25 and then 500.50, not in decimals like we have now. So it was quarter half, quarter half, quarter half. So the specialists made an absolute fortune, and we moved to decimals about 12 years ago. So that changed that and took that big advantage from that. But anyway, that's what we're looking at in the Treasury bond market. Now the next commodity that I wanted to cover is the live cattle market, because we have something really exciting happening here on a long-term basis. Our friend Rich Anderson from Anderson Capital Management has been in contact with us. Every couple of weeks he comes on, and we have a huge pattern forming in the long-term weekly charts of cattle, and that means that cattle should be topping somewhere between now and the next few days between this 134 and 138 level. So we'll be watching that here in the commodity show to take a look at this, because this has been a really big move in cattle. And what I'd like to do is historically go back and show you the last time we had one of these occur, which was back in, this takes cattle back about 7 or 8 years. And the swings on this, if you believe in Fibonacci, you'll absolutely love this chart, because This long-term weekly chart going back 7 years shows the three drive to a top pattern that we had into 2008, and then cattle dropped about 25%. They stopped exactly at the 786 of the 2006 low. It hit that 4 times, and then it started the huge bull market that started in November of 2009 that we're in right now. And what's happening now is we're completing this huge three-drive pattern that has been forming for quite some time, and we are within a heartbeat of this thing being perfect in price and time. So this could be the fact that we might get a break in beef prices after these last 7 years, because we've been paying quite a bit, mainly because the price of grain has gone up so much. But remember now, the price of grain has backed off a great deal over these past few weeks, and that should make cattle cheaper, but in fact it's not. And the main reason is that they cut back their herds because they couldn't afford to feed them. So the few cattle that are out there, they have to keep now for breeding, and that makes less beef on the market. So as soon as the cattle start breeding again, which is I don't want to get nasty here, but they're probably in the process right now, and then we will be able to get cheaper prices, in beef down the road. But we, on a timing scale between top and top, it should be within the next week or two when we're coming into a price of cattle, and we'll be watching that, very close. Cattle trade quite nicely. They trade electronically. The volume is pretty good, so they handle just about any type of normal size. The hedge funds are in there too, so you do have quite a bit. But this will be a good thing to look at for a longer term setup, because it's a beautifully symmetrical chart. Every single low between 2006 and where we are now was either exactly 786 or 61%. Every single one. There were a total of 8 of them. And all 8 were either 6 of them were 61% and 2 of them were 786%. So these numbers work very well. And on the expansions on the upside, they were either 1.27 or 1.618. So it's got some really good symmetry in this, and we'll be watching this, very, very closely over the next few weeks, because the price level we're looking at, we're making new highs today at this 134 level, and we're looking at another 2 to 4 cents, 136 to 138 in cattle, and then we will look to find a place to get short, finishing this three-drive pattern that we're looking at right now. Someone asked me to take a look at the NASDAQ. The NASDAQ has actually gone up and touched gone a little bit above the 61% retracement of the whole move by about 10 points, and that's actually a good sign. But we've had this huge gap also in the NASDAQ that we left 2 days ago. And if you look at the NASDAQ chart, just go back and look at the last 2 years, and you'll see that we don't have any gaps on this chart at all. And, that's the main thing. Someone else asked the question, is there a potential for a head and shoulders pattern in the NASDAQ? And the answer to that is, if you just look at it, it looks like it could have a head and shoulders pattern from the, first of all, we'll take a little break, and then we'll come back and we will talk about the head and shoulders pattern in the NASDAQ, and then try to wind up the show. 877-927-6648.
If you're an investor looking for a great weekly investment newsletter, then now is the perfect time to try out Ken Shreve's Ultimate Growth Stocks. Every Tuesday, Ken breaks down multiple sectors in his weekly newsletter, Ultimate Growth Stocks, with a full in-depth report including specific trading recommendations within his model portfolio, charts, sector analysis, upcoming economic data, along with intra-week trading updates on newsletter positions whenever the market dictates. Right now, you can receive a full month, that's 30 days, to evaluate Ken's newsletter free of charge to see if it fits your trading plan. At less than $75 per month, Ken provides you with his expert trading advice that can pay for itself in no time. Take advantage of this great offer by signing up for a 30-day free trial to Ken Shreve's Ultimate Growth Stocks today. Don't let this offer pass you by. Visit the front page of TFNN.com and sign up now.
with the launch of Tiger TV. TFNN has brought our programming to the next level. With Tiger TV, you can gain access to each host's charts and computer screens as they host their daily stock program. Whether it's Tom O'Brien, Steve Rhodes, Basil Chapman, Ken Shreve, David White, Larry Pesavento, Victor Jones, or Terrell Martin, you can catch all of our technicians hosting their programs live and archived on Tiger TV for your viewing pleasure 24 hours a day, 7 days a week. If you haven't checked out Tiger TV, then visit TFNN.com and see what you're missing.
David White's newsletter, The Technology Insider, is focused like a laser on finding the next big things in technology. If you had invested only $10,000 in Microsoft in 1986, you'd have been a millionaire by 2000. Disruptive technology like Microsoft's is the key to these massive long-term profits, and the Tech Insider is the vehicle from TFNN to capitalize on these opportunities. This is the go-to newsletter that identifies, monitors, and profits on mostly little-known cutting-edge companies with great long-term prospects. David's experience is as an inventor of Emmy-winning animation products for TV and Hollywood that propelled a company public. Match that with 14 years as a full-time trader, and he's uniquely qualified to guide you through the light-speed world of ever-evolving high-tech. If you're ready to ride the next big technology bull market for less than $40 per month, log on to TFNN.com and get your 2-week free trial to the Technology Insider. Get in on the ground floor of the next big thing today.
Many of our new listeners have heard about the Tiger's Den, but wondered, what exactly is it? The Tiger's Den is a lively community where professional traders and investors can meet, exchange ideas and information in a comfortable, moderated atmosphere. Hear all of your favorite TFNN shows, plus see all the charts as they happen, live during those shows, and have access to all those charts. You can test drive the Tiger's Den, absolutely free, for 30 days. It will greatly enrich your knowledge of these markets. Details on the Tiger's Den are on the front page of TFNN.com.
Are you looking for a precision edge in the market? Something that can stack the odds in your favor? Then look into Larry Pesavento's new trading newsletter, Patterns, Profits, and Peace of Mind. In each weekly issue, Larry explains what's going to happen in the markets based on the pattern he sees developing and gives you actionable trade ideas based on those patterns. Plus, you'll get his detailed analysis on a variety of markets and sectors, including stocks, treasury bonds, the gold market, oil, the dollar, the Forex market, and more. And you'll get the Technical Corner segment, which is a short but powerful weekly training session on trading. You'll get access to all the patterns Larry is seeing in the markets, plus the Astro Harmonics and powerful Bradley stock market model that Larry utilizes for less than $5 a day. An extremely potent combination that will give you just the edge you've been looking for. Try Patterns, Profits, and Peace of Mind absolutely free for 2 weeks. Go to TFNN.com and click on the free trial link at the top of the page. That's an $85 value, yours free when you register right now. Get Larry's Patterns, Profits, and Peace of Mind and get the edge you've been looking for.
This segment is brought to you by TFNN. Test drive all the newsletters for free at TFNN.com. Now, back to the Futures Hour.
Okay, we're back, folks. And what we're doing is we're taking a look at the NASDAQ, because there is a potential that, we could be at a head and shoulders pattern here up around this 2750 level. But it's still too early to tell because of the gap that we left. We left this huge gap, and that's usually not a very good sign, to tell you that. Now, most of you folks know that I follow the foreign currency markets, really quite a bit. That probably 70% of my trading is based on the futures markets. Between the combination between futures and Forex is about 95% of everything that we do. The other 5% is occasional stock and some options, but usually it's Forex. Forex is the biggest thing that we look at. The one thing that I wanted to bring to your attention is there's quite a bit of information on the internet about the Australian dollar, because it is known as the risk-on, risk-off Forex. In other words, if the commodities go straight up or stocks go straight up, the Australian dollar usually follows, and that has a relationship with the VIX index. And what I'm going to do is I'm going to show you this relationship. It's actually an inverted. In other words, as the VIX goes up or down, the Australian dollar will actually move higher. So if you'll notice, with this big move that we've had in the VIX on an inverted basis, the Australian dollar has not really done very much. This is very uncharacteristic of the Forex market, because the correlation here is really quite high. So this is another thing to keep in mind, that you ought to sit on your hands for just a little bit and not worry about what the market's going to do for the next few days. Remember, there's nothing you could do until 6 o'clock in the morning on the January 2nd when the market gapped up 40 points. And since that point, we've gone another 17 points higher in the next 12 hours of trading. So it's really gone just a little bit higher. Now, the same thing is true of the IWM. So there's really, what you want to do is to try to just sit on your hands here and give yourself a little bit of time, because I think we're going to, at least start to look to fill that gap, if nothing else. That's for sure. Now, we also talked about copper, and copper has had a move where it has, gone up to the 61% retracement, and then it backed off quite a bit, and it's backing off today. So that's another possible sign that we are getting ready for some type of correction here. So I'm just mentioning that you might want to keep your powder dry just a little bit longer, and I think you don't have to risk very much, because right here you have to risk a great amount, and this is one of the reasons why we really try not to do that when we do that. The price of Apple, to me, it still looks incredibly bearish. I mean, it really has done nothing. Well, it's rallied 10%. That's nothing, but it's just really rallied just a tiny bit. I believe we still got a chance, for Apple to see the 394 level. That's what it looks like to me. Compared to what the rest of the market has done, Apple has done, virtually nothing. It hasn't even taken out the highs of, December 3rd, whereas everything else in the whole world has done that. So, Apple is still relatively weak. We're below yesterday's open even. And if we have a gap in Apple that is down about $15, and then you'll take a look at it there, but, wait and see. All I'm saying is these are outlier events that we have going on, and you just ought to wait a little bit. That's the bottom line. I don't see any reason to do it. Anyway, that's it, folks. Live every day in an attitude of gratitude, and may God bless.
Let me tell you something, folks. I have people coming up to me saying, I just can't believe the amount of work that Steve does on his newsletter. And I says, I absolutely agree.
That is a recent clip from the Money Masters show that Tom and I do each day at TFNN. My newsletter service, Mastering Probability, is much, much more than a newsletter. Yes, it's outperformed the S&P 500 by 100% during the last 15 months. But more importantly, it's an extraordinary education, a roadmap for your success. And it's yours risk-free for the next 30 days. Just go to the homepage of TFNN.com and click on my name, Steve Rhodes, and then Mastering Probability, because everyone needs a success strategy. For most, it's a competitive edge, the will to win, the drive to overcome any obstacle. Whatever you call it, winners find a way. Find your way to Mastering Probability today, because your journey to extraordinary rewards is just one click away.